Welcome to the Book MBA channel. Today we're dissecting a classic in the investment world, a book that has guided countless aspiring investors, The Warren Buffett Way, by Robert Hagstrom. This isn't just a collection of anecdotes, it's a meticulously organized framework that distills the core investment principles and decision-making processes of Warren Buffett. If you've ever wondered how the Oracle of Omaha consistently beats the market, this book provides the detailed blueprint. Get ready to learn the disciplined, intelligent, and remarkably simple approach to building enduring wealth. Part 1. The Foundation: Buffett's Intellectual Roots and Philosophy. Hagstrom begins by establishing the intellectual bedrock upon which Buffett's success is built. This isn't about complex algorithms or market timing, it's about a fundamental understanding of business and human behavior. Benjamin Graham's influence: value investing. The book starts by highlighting Buffett's intellectual debt to his mentor, Benjamin Graham, the father of value investing. Graham taught Buffett the concept of stocks as fractional ownership of a business, the importance of analyzing financial statements to determine intrinsic value, and the critical idea of a margin of safety. This means buying a stock for significantly less than its calculated intrinsic value, providing a cushion against potential errors or unforeseen events. The market, Graham taught, is a manic depressive named Mr. Market, who offers you prices daily, sometimes ridiculously high, sometimes ridiculously low, and your job is to take advantage of his irrationality. Philip Fisher's influence: growth investing, with a twist. While Graham provided the bedrock of value, Hagstrom shows how Buffett also integrated principles from Philip Fisher, who emphasized investing in high-quality growth companies with strong management and competitive advantages. This was crucial for Buffett, moving him beyond simply buying cigar butts to investing in wonderful businesses at a fair price. The evolution of Buffett's approach. Hagstrom details how Buffett, particularly influenced by Charlie Munger, evolved his strategy from buying fair businesses at wonderful prices to wonderful businesses at fair prices. This shift meant a greater emphasis on qualitative factors like brand strength, management quality, and competitive moats. Part 2. The Business Principles: What Makes a Wonderful Business. This section dives deep into the characteristics Buffett seeks in the businesses he invests in, regardless of their stock price. Simplicity and understandability. Buffett only invests in businesses he can fully comprehend. If the business model is too complex, or he can't clearly articulate how it makes money, it's out of his circle of competence. This eliminates many high-tech or speculative ventures. Consistent operating history. He prefers companies with a long track record of stable and predictable earnings. This allows him to project future performance with greater confidence. Favorable long-term prospects. This is perhaps the most famous and crucial principle. Buffett looks for businesses with a sustainable moat, a durable competitive advantage that protects their profits from rivals. Hagstrom elaborates on various types of moats. Brand identity. Powerful, recognizable brands that command customer loyalty and pricing power. Cost advantage. The ability to produce goods or services at a lower cost than competitors. Network effects. Where the value of the product or service increases as more people use it. Patents and proprietary technology. Unique intellectual property that creates a barrier to entry. Switching costs. The cost for customers to switch to a competitor. Regulatory advantage. Industries where regulations limit competition. Rational and shareholder-oriented management. Buffett deeply scrutinizes management. He wants leaders who are honest, competent, and who act like owners themselves, prioritizing shareholder value over personal gain or empire building. He values transparent communication and a focus on intrinsic value. Part 3. The Financial Principles: Crunching the Numbers Buffett's Way. Once the business principles are met, Hagstrom then details how Buffett uses financial analysis to value a company. This isn't about complex algorithms, but about understanding a few key metrics. Focus on return on equity. Buffett looks for companies that consistently generate a high return on the equity invested in the business without relying on excessive debt. This indicates efficient use of capital. Look for high profit margins. Healthy profit margins show a company's ability to control costs and effectively price its products. Assess how earnings are used. He prefers companies that can reinvest their earnings back into the business at high rates of return. He focuses on owner earnings, the cash a company generates that can be distributed to shareholders without impairing the business. Avoid excessive debt. While some debt is normal, Buffett is wary of highly leveraged companies, as debt can amplify losses during downturns. Conservative accounting practices. He prefers companies that are transparent and conservative in their financial reporting, avoiding accounting gimmicks. Part 4. The Valuation Process: Putting it all together. This section details how Buffett combines the business and financial principles to determine the intrinsic value of a company and decide whether to buy. Discounted cash flow analysis. While Buffett doesn't always use formal DCF models, his thinking aligns with its principles, valuing a business based on the present value of its future cash flows. He focuses on the cash a business can generate over its lifespan. Margin of safety. After estimating intrinsic value, Buffett only buys if the market price is significantly below that value. This provides a buffer against errors in judgment or unexpected events. It's about building a fortress around your investment. The look-through earnings concept. When owning a large portfolio of companies, Buffett looks at the earnings of those underlying businesses, not just the dividends paid, recognizing the power of reinvested earnings. Be patient and disciplined. He waits for the right opportunities, and once he invests, he's prepared to hold for the very long term, often decades. He resists the urge to trade based on market noise. Part 5. Managing a Portfolio, the Berkshire Hathaway Model. Hagstrom also explores how Buffett manages the overall Berkshire Hathaway portfolio, which is itself a diversified collection of businesses. Concentrated portfolio. While he owns many businesses through Berkshire Hathaway, his publicly traded stock portfolio is relatively concentrated, focusing on a few high-conviction ideas. He believes in putting his eggs in one basket and watching that basket very carefully. Avoid diversification for its own sake. Diversification is a protection against ignorance. If you truly understand a few businesses, over-diversification can dilute your returns. Buy businesses, not just stocks. This reiterates the core philosophy. Each public company investment is treated as if you were buying the entire enterprise. Capital allocation is key. Buffett considers capital allocation, deciding where to deploy cash, whether for acquisitions, share buybacks or dividends, to be the CEO's most important job. Conclusion. The Warren Buffett Way, by Robert Hagstrom, is more than just a finance book. It's a masterclass in rational decision-making and disciplined investing. It teaches that enduring wealth is built not through complex strategies or market timing, but through a clear, fundamental understanding of business, a relentless focus on value, and the unwavering discipline to act rationally when others are driven by emotion. Buffett's genius lies in his ability to simplify complex situations, stick to his principles, and leverage the power of long-term compounding. This book provides a roadmap for anyone looking to adopt a more thoughtful, less speculative, and ultimately more successful approach to investing. It's about being patient, being knowledgeable, and letting time be your greatest ally. Thank you for joining the Book MBA channel for this deep dive into the Warren Buffett way. If you found these insights valuable, please give this video a thumbs up, subscribe to our channel, and share your biggest takeaway from Buffett's philosophy in the comments below.